Okay, hello everyone. This is your tutor Sam here. I've been asked a number of questions regarding how to come up with a spread or how to actually put together a trade involving what's called the first to default basket or FTD. First to default. Now, I think in view of the somewhat urgent nature of the coming up assignment, I will try to say a few things about this without actually giving away completely the requirements of the assignment. But let me try and clarify a little bit. Now, let me take a step back, and you'll see why in a moment. I want to talk a little bit about the credit default swap first, okay? Which is the short form for that is CDS, okay? And first to default basket is sometimes called the FTD. Now, if you are running a structured credit desk, and a client comes to you and say, I want to buy a credit risk instrument linked to some company out there which may not actually trade very frequently, and there may not even be an actual physical bond available for you to buy, but let's just say there is a CDS market. So what you can do is, so this is the investor, okay? So the investor will, this is typically how a trade is done. The investor will give $100 to the, let's say the iBank, Morgan Stanley or whoever, okay? Now, so the DBS trade actually has some resemblance to this. They're all manufactured in a similar manner. So the investment bank will hopefully place this $100 somewhere in either in the money market, short-term money market, or they can actually go out and buy US Treasuries, but of course you get a much lower yield, okay? And depending on what you do, you can get a fixed rate, or you might get a floating rate. But let's just keep it real simple. So let's say you get a fixed rate of 5%, okay, per annum, and let's say you do this for 7 years, okay. Now, what you can do then is you go to the credit market, and you also get in touch with a CDS trader, and you sell, okay? So you sell protection based on 100 million notional on, it depends on what, let's say that the investor wants an exposure to China Airline. Let's just say, okay, it doesn't really matter. And if maybe they pay for that 2.5% or 250 basis points, then in theory the iBank is now per annum, that is, okay, per annum. So in theory the iBank is now in a position to pay a maximum 7.5% by issuing a single entity credit-linked note based upon just a single name, CDS. Now, of course, they're not going to pay 7.5%. Who are you kidding? They're going to make some money. So they might pay, 7.25%, or maybe just 7%. Let's say, okay. So they're going to make some fees. So that's how they make their earnings. It's like anything, So somebody you go to a restaurant and they cook your lunch or your dinner for you, and you pay $100. You think the ingredients are worth $100? Of course not. Okay, but they're going to make a profit, so they charge you $100, but the ingredients and the service and the rent and this and that, it might come to like $80. So this is kind of the same. Okay, now if you understand a CDS, okay, I now explain to you the FTD, which is actually fairly similar. It's similar in that the investor is still giving the iBank, so let's say Morgan Stanley, is still giving the iBank $100. Now in the case above, so if nothing happens at maturity, then the investor, the iBank will get $100 back from the money market, and there will not be a claim from the CDS trader if there's not been any credit event or bankruptcy. Okay, and then the $100 just goes back to the investor. But if something did happen, then the CDS, the protection buyer here, has a right to demand that $100 payment, and then will deliver a bond to the iBank, who will in turn deliver that bond to the investor, and they'll tell the investor, well, bad luck, you took an exposure in China Airline, and guess what, they went bust. Now that's the credit default swap, which is this transaction here. And when you do a trade like that, it's typically called a credit link note. So you pay money and you buy something. Okay, now if you were to trade a first to default basket note, okay, here is what happens. So you still pay $100 to Morgan Stanley, and they still go to the short-term money market or the US Treasury market, and they will still pay away that amount, and they get a so this is kind of the base return. Okay, now I'm now giving you details that have an approximation to the Constellation deal, or what I know of it. Okay, so the base return would be like 5%. Of course, that by itself isn't really that interesting, because 5% is what you get with US Treasury. So practically, it's just a risk-free rate. So you got to do more than that. So what Morgan Stanley would do is they would go out there and again, they would talk to an FTD trader, okay, and they will sell protection. They will sell protection on, let's say, not one name, but 7 names. Okay. Now, in the case, I think the companies that were mentioned were included the names where the client will take an exposure are UBS, Citigroup, BOA, Deutsche Bank, HSBC, JP Morgan, Goldman Sachs, and Morgan Stanley. Okay, so maybe I'll change this to BNP, so they're not one of the involved parties. Okay, so BNP is now manufacturing this deal, and so they sold protection on 7 names. Now you can see that here when you look carefully. So these are the individual credit spreads: 32 basis points, 32 basis points, around 27, 42, 37, 50, 78.5 and 75 basis points for Morgan Stanley. Okay, so it's not as high as the 2.5% I just made up on China Airline, but it doesn't matter. Okay, now the point to note is this. So what happens when you buy a note like that? So you've now bought an FTD, first to default basket note. Okay, basket note, and the FTD trader will pay you a certain spread. What is that? I'll come to that in a moment. Okay, now the first thing to think to keep in mind is that for the investor, the exposure is on 7 names, but this is an FTD. That means if, let's say you are doing a what did I say, 5-year? It should be a 7-year trade. So within the next 7 years, okay, if one of these names defaulted, and it doesn't matter which one, if one of them defaulted, okay, you will be hit with that damage, and it's the first one to default. As soon as you have one company defaulting, okay, then you are going to be hit. So let's say Morgan Stanley defaulted, then what would happen with the investor is they would have to take the loss as if they actually bought a credit-linked note where Morgan Stanley was the underlying risk that they are taking. Now, it's called first to default because once there is a default, the first one is the one that will cause your damage. After that, the second, third, fourth, fifth is not your business anymore. Well, you've already taken the loss. Okay, so first to default really is you just take the first hit, if there is a first hit. Okay, number one. Now number two, so obviously your credit risk has increased because now you are taking exposure on 7 names. Okay, 7 names. Okay, and your premium, okay, of course is driven by it's really a function of the multiple names. Okay, so it's credit risk of 7 names. Okay, it's a function of that. So your premium should go up, the premium that they pay you. Okay, so now the third point I want to make here, and this is an important one. Okay, so I think this is why I think this product is quite fascinating, because if you understand the classic concept of leverage, okay, so for example, when you are trading a futures contract, you may be trading a notional principal of 1 million, but you only need let's say 100,000 of your own capital. Now that's the classical way we understand leverage. So this is notional principal, and when you trade on a leverage basis like that, your return can potentially go up, but your risk also goes up, and your maximum loss can be it can be $1 million. Okay, so if you commit $100,000 of your own capital, and then you engage in margin trading, and you pump it up and you buy stocks which are worth $1 million, in theory, you know, your maximum loss is going to be 10 times the capital you commit. Okay, now here's the rather subtle point with this first to default basket. So your risk has gone up, okay, and therefore your return also goes up, okay, but your maximum loss, now, so if your risk goes up and your return goes up, you immediately you think, okay, there's a leverage in there somewhere, and leverage, therefore it means that I should at least potentially find myself suffering from a loss which is bigger than the capital I committed initially. So that's the classical way in which we understand leverage. Now in here, your maximum loss, even if you buy one of these things, is still $100. That's the worst thing that will happen to you. However, what is really the nuance here, the subtle part, is that although your maximum loss hasn't changed, okay, the probability of you getting a loss is now higher, okay. That is how the risk has increased, okay. So your maximum loss hasn't changed, but the probability that you may well incur that loss has gone up, and therefore the return has gone up, okay. Now, for that reason, if you think deeply about this, okay, I ask you a simple question. You are taking exposure on 7 names. Yes, you are, okay, but you only get hit with the first one that goes down, and you will never incur 7 times the loss. Here you are not going to lose $700 when you commit 100. Okay, now in that case, I ask you, if these are the individual spreads of the entities, should you really be paid just the sum of all of them added together? No, I don't think you should, because you would be paid the sum of all these if you are really taking on the risk of losing $700 when all of them, let's say all of them go bankrupt, okay? If all of them go bankrupt and you end up losing $700 by putting up 100 to start with, then I would say yes, you should be paid the sum of all of them, okay? Now, that's the thing I find so clever about first default basket. So you don't get paid a sum. Now, what is the sum? First of all, the sum is around 376 basis points. In fact, somebody has done the calculation. 376, okay? The sum of all the spreads. You do not get paid that, okay? So point number 4, you don't get paid sum of the spreads. There's actually a course next term which goes into a lot more detail about this topic, okay? But now I want to try and give you some clues for your assignment, just in the interest of time. All right, you do not get paid the sum. Now the sum is 376, okay? And you can see here that the maximum spread, in fact, is with Goldman Sachs, okay? So common sense tells you, and what is the spread there? 78 basis points roughly, okay? So common sense tells us that what you should be paid for this first default basket note should be somewhere between 78 and 376. Now, if it's lower than 78, somebody's going to say, why should I even bother taking the risk on 7 companies? I just take the risk on Goldman Sachs. Already I get 78, okay? So you can't do that. And I already told you, you shouldn't be paid 376 either, because you are not risking $700. You're just risking $100. So it has to be somewhere in between, and that is the point about question 1. What should the spread be? Now, by my experience, okay, and my observation, the spread that should be paid normally is the sum of all these multiplied by somewhere around 70%, okay, so that makes it around 280 basis points, let's say. However, okay, the range is probably, there's a range between 60 to, let's say, 75, so sometimes higher, sometimes lower, okay. Now you must be wondering, yeah, well, what makes it higher, what makes it lower, okay? Well, you have to understand that the premium or the spread that you get paid is driven by the risk or the probability of at least one default, whether it's 1, 2, 3, 4, or 5, okay, it doesn't matter. Now, which is equal to 1 minus the probability of no default, okay. Now that's actually driven by, what do you think? Correlation between the entities, okay. And if the correlation between the entities are very high, okay, let's say they are very high, so they are very highly, they're similar companies, they're highly correlated, okay. So when correlation goes up, okay, the probability that there is no default actually goes down. No, I beg your pardon. The probability, no, I got that the wrong way around. If correlation goes up, okay, the probability that nothing will go wrong will actually go up, okay, and I'll explain why that is the case, okay. Now imagine if correlation goes down when you have a basket of very, very different companies, okay, there is actually a bigger chance that some company will get a problem, okay. So you have a basket of companies. There's an airline, there's a bank, there's some in the film industry, there's one in IT, there's one in pharmaceuticals, you know, totally diversified portfolio. Then there is a higher chance that something will go, someone is going to step on a landmine, okay. So but if they were highly correlated, actually the probability that something will go wrong is lower, okay. And as a result, the premium that gets paid is lower. Now this is a point that I think you just have to maybe replay this video around this part and then start thinking about it for yourself, okay. I think I have told you enough about FTDs and how you determine the spread. First of all, you don't just add them up, okay. You apply a certain discount, and what kind of discount should you apply? Well, like I said, it depends on the correlation. If and when a basket is very, very uncorrelated, maybe it's easier if I do it the other way around, okay. If a basket is uncorrelated, so you've got a rag bag of a lot of different companies, all shapes and size and different businesses, when the correlation is low, the probability that some company in the basket will get in trouble is actually higher, okay, and as a result you get paid more. Now in this case, you look carefully, in fact these companies are strongly, very, very highly correlated. You can't, they're all banks, they're all boring old financial institutions, okay. So I would argue that in a case like that, because correlation is so high, all the arrows go the other way. Okay, so this one goes down, this one goes down, okay, and this one goes up, and this one goes up. Okay. That's it. I think I have given you enough clues about how to handle this. And the other thing to possibly keep in mind is the relationship between the credit spread, the spread that you get paid, okay, which is equal to the probability of default, okay, multiplied by what's called LGD, loss given default. Like I've said to you before, I think I said this in the first or the second tutorial, the problem I have with credit risk modeling is that this is an estimation and this is also an estimation. So you got one equation and two unknowns. So there's a lot of guesswork in there. Sometimes with the LGD you really don't know. With some companies, if you know what assets they have, and if they're in real estate and you know what buildings they own, it's a little bit easier. But when they have a big business or a really complex balance sheet, it can actually get quite hard. Okay, so I hope this is helpful to you, and I'll see you guys around. And thank you for listening. Thank you very much.